Hey, what's up guys? Welcome back to the channel. So in March, coronavirus crippled the stock market and it reached lows that we haven't seen in many years, and it stopped the longest bull run in history. Now, the stock market has since returned and it's actually reached new highs since that point. But in the last 2 weeks, we've seen a sell-off of stocks and we've seen the stock market decreasing consistently over a 2-week period. So what is going on? So a quick backfill, which I'm sure most of you will know, but I'm going to put it in there anyway. So in March, coronavirus basically crippled the stock market, and as a result, governments put in subsidies and different grants to prop up businesses and ensure that there wasn't a complete total collapse of the economy. Now, this worked fantastically, and it reinstated confidence in the stock market, and it's improved the position of the stock market massively since March, so that by the time we got round to the June-July period, the stock market was actually breaching new highs and was higher than it had been before the coronavirus period, despite several of the largest countries in the world still being in lockdown and dealing with numerous cases of coronavirus on a day-to-day basis. However, as of right now, the 29th of October 2020, the stock market is down 5% over the last 2 days, continuing a slump of almost 7% over the last 2 weeks. But with the stimulus checks and with government grants supporting businesses, what on earth is going on? So firstly, I want to preface all of this with a warning from Robert Shiller. Now, Robert Shiller is a leading economist, and what he does is he interviews investors around the world to find their confidence in the stock market. And at the moment, what he's found is that there is a higher proportion of investors who aren't confident in the stock market and believe that a large market crash is on the horizon, a larger proportion than we have seen in many years previously. Not only is there a higher proportion of investors in the higher ends of the market that believe that there will be a large stock market crash, but also the stock market is at the highest point it's ever been, which is weird because you'd expect if investor confidence is low, that the stock market being high would be a dangerous thing. And so this is something that we all need to consider, is that the stock market is the highest it's ever been, whilst investor confidence is the lowest that it's been in many years, and this could be the warning sign of a soon-to-come crash. However, it is worth pointing out that the resurgence of the stock market isn't entirely hocus pocus and backed by government loans and crazy gambles from different companies, and that actually what's been leading the resurgence of the stock market is tech companies. So these tech companies experienced a small initial blip due to coronavirus, as did all other companies, but as the coronavirus has continued, tech companies, especially companies like Zoom and Amazon, have seen more and more people driven to their sites to use their online platforms. So as a result, these companies' stocks are sailing to heights that they've never seen before. For example, Amazon topping out well above $1.8 trillion. Secondly, there has also been a sizable cash injection into the stock market from day-to-day investors like myself or day traders. Now, I invest for long term, so when I buy a stock, I do want to buy a stock to hold for 5 to 10 years because I believe that's the best way to see a stable return. But there are plenty of people around the world who have taken the extra time that they have during coronavirus to put as much money as they can through apps like Robinhood or Trading 212 into the stock market. And this additional cash injection has seen different stocks grow at rates that don't necessarily follow traditional rules. But both of those things are still continuing at this point in time. At this point in time, tech companies are doing incredibly well. Apple, Amazon, Google, they're all seeing increases in their stock day on day. And also, on top of this, there are still a lot of investors who invest with Robinhood or Trading 212 putting money into the market. So what exactly is going on? Why is the stock market falling? Well, firstly, there's the obvious reason, which is that the second wave of coronavirus is upon us. Now, you can argue whether it's the second wave or the first wave that governments around the world just failed to treat properly. However, that doesn't change the fact that this is a second or a continuation of the first wave of coronavirus, and that the cases are growing day by day. For example, in the UK and in America, the cases are growing, and it looks very similar to the growth during the first wave of coronavirus that crippled the economy. As a result of this brings instability, which is something that the stock market doesn't like, but it also brings a reduction in the consumption of people. Because, for example, people can't go out for their meals in the evenings, or they can't go out drinking and using hospitality as much as they would, so the total consumption of a country decreases. This is prevalent in the UK, for example, where all bars and clubs now have to shut at 10 PM, so there's a whole revenue stream that has essentially been closed off, which reduces the amount of capital going around these different companies, which in turn has a negative impact on the stock market and the confidence in the stock market in the UK. Secondly, there is also the upcoming US election. Now, as I previously mentioned, the one thing that the stock market doesn't like more than anything else is uncertainty and instability. And leading up to an election, although traditionally the stock market rallies between 0.5 and 2 and a bit %, the uncertainty and the instability of who's going to get elected can have a negative impact on the stock market, especially in the current situation that we find ourselves in, with Donald Trump versus Joe Biden, two rather opposing views, which may have very differing impacts on the stock market depending on who gets elected. Now, it is worth mentioning that actually, historically, the choice of who gets elected, whether they're Democrat or Republican, doesn't have a significant impact on the increase or the decrease in the stock market. However, the uncertainty is what drives the impact of the stock market. So not knowing who is going to be elected is something that damages the economy. It is still worth considering who would be better for the economy if they were elected, Trump or Biden. So I'm going to go through my own personal opinion on these options and give some of the for and againsts for both of them. Now, I live in the UK and I can't vote in US elections, so I'm not necessarily the most knowledgeable on this, but I still have an opinion on the matter because at the end of the day, US politics affects world politics and the world stock market. So some of the arguments for Trump getting re-elected is that traditionally the stock market actually rallies if a re-election occurs. So if the same president is re-elected, the stock market tends to rally and increase. Secondly, Trump also obviously puts on his hats and is very proud of Make America Great Again. And he is driven to do everything he can to make America a superpower. So it's believed that if he gets re-elected, then that will strengthen the economy because it means that he is putting businesses first. And thirdly, there's a positive for the economy by electing Trump, which is that he is promising tax cuts and tax breaks to the wealthy and to corporations. Now, although this may not be beneficial for the general public, it will certainly strengthen the stock market, as companies will be able to increase their profits and their capital and reinvestments into their own businesses. However, going against Trump, as I've said many times in this video, stability and uncertainty are things that the stock market doesn't like. And Trump does not provide stability or certainty. If you look at his current period of presidency, with decisions about China, the war, Russian affairs, there have been lots of U-turns and quick changes of opinion and very brash decisions by comparison to what other presidents have done. And so as a result, this uncertainty could bring down the market as opposed to strengthen it, as Trump says he will do. Now, directly contrasting this, we have arguments for Biden, which is that he's a slightly more calm, collected head, as people would say, and he's much less likely, or at least people view him as less likely, to have these sudden brash decisions that Trump has made popular throughout his presidency. So this stability and certainty may steady the stock market and may prevent a slide or prevent a decrease in the stock market. There is also the view that Biden will be more likely to take COVID more seriously and to prevent the spread of COVID, whether that is through another lockdown. Now, although another lockdown would damage the economy in the short run, what it would offer is the opportunity to completely take care of COVID correctly, so that in the long run, there is a quicker uptake of society where people can return to their jobs and start improving the economy more quickly, because COVID won't be a worry to as many people. However, against Biden, we have the argument which is the opposite of one of the points for Trump, which is that Biden wants to increase the tax on the wealthy in the 1%, which not only may have the impact of cutting into the profit margins of large companies and damaging their stocks, but also it may have the impact of driving certain companies and investors out of the country if they deem that the taxation is too high. For example, in the UK, there are certain companies which are withdrawing their operations from the UK as a result of Brexit because of increased taxes or increased restrictions and the uncertainty that they can't count on. And if a similar thing occurred in the US, then the damage to the stock market could be very significant. So overall, really, it comes back to that term uncertainty. It's uncertain as to what's going to happen, but the stock market will be hurt by uncertainty, not necessarily by one person or the other being elected. So the sooner we know who's elected, then the sooner the market can be stabilised and the sooner that the market can continue to grow. And a third and final point, which I touched upon earlier with strengthening the stock market as opposed to weakening the stock market, is the influx of day traders and for people with spare cash during coronavirus and spare time to use apps like Trading212 and Robinhood to get involved in the stock market. Now, while this has strengthened the stock market and provided extra capital for investment, it has also made the market significantly more volatile. with certain stocks being bandwagoned and with the stocks flying up way higher than they should do and then simultaneously crashing much further down than they should have done. And so as a result of this volatility leads to more uncertainty, which could in fact damage the economy. So one thing that will be really interesting to see is that if this slide continues, if the market keeps dropping, then all the investors that started using Trading 212 and day trading and get involved in the stock market, it will be interesting to see whether they hold firm and continue investing or whether they get scared and pull their investments. At the end of the day, everyone's a genius in a bear market because the stocks can only go up. So everyone who invested in March, or most people who invested in March, will most likely have made money. But now that the stocks are starting to slide and it may be more difficult to pick those stocks that are going to gain value, it'll be interesting to see whether we return to a previous norm of Wall Street leading the investments and more rational behaviours leading the investments, or whether it will be people on Trading 212 and these apps still leading the fore, creating hype stocks and hype investments that people get behind. If these traders do get scared and start pulling their investments, then this could compound the slide in the market and we may see a greater dip in the market than we previously expected. So it will be interesting to see how this develops and to see what happens with the influx of capital from those investors. So those are the three key things that I think are impacting the stock market at this point in time, but I do want to mention one final really important point, which is that historically, the market recovers over a long period of time. So long as you're investing for a long period of time, 10, 15 years, the market will recover and you will regain your profits. So don't necessarily panic and sell off just because the market starts dropping and putting in stop losses left, right and centre for all your investments. So I just quickly wanted to jump in and add that I recorded this video this morning and it's now the evening and the Q3 GDP results have been released and the US GDP has increased by over 33% from Q2 to Q3. Now, the impact that this has had is to increase the stock market by roughly 1.7%, and this kind of contradicts the rest of the video, but the point still stands that the uncertainty is what's driving the slump in the market, and that even though the GDP has increased from Q2 to Q3, it's not increased by enough to overturn the deficit that we've seen this year due to coronavirus. So there's still that point that the GDP of the US doesn't really match the height of the stock market that we're currently seeing, with the stocks being higher than they ever have been at any other point in history. So there's still that uncertainty and there's still the volatility in the market that could decrease the stock market. It's just that we've seen a slight rebound in the market today as a result of this GDP outcome. Now, another point that's worth making is that experts have also said that it could take years to recover the GDP deficit as a result of the coronavirus, which is just going to lead to more uncertainty and could lead to more slides and more decreases in the stock market in future. So that's one thing to bear in mind, and I just wanted to highlight that to make sure that this video kind of showed a complete overview of the current point in time. So anyway, on with the rest of the video. So that's everything. Now, I do hope that the stock market stabilizes and recovers, because when the stock market's crumbling and losing value, nobody's happy, except for maybe a few people who've shorted the right stocks. But anyway, that's everything for today. If you did like the video, please hit the like button down below. It really helps the YouTube algorithm. Subscribe if you're new around here. Let me know in the comments what you think's going on with the stock market, which way you think it's going to go off the back of the election. And as always, thanks for watching, and I'll see you in the next video.